Let's bring in Chuck Stevens, CFO of General Motors, who joins us from the company's headquarters. Chuck, let's get right to the main thing that's bothering investors this morning. You guys bringing down your full-year earnings guidance, and this primarily has to do with the impact you're going to be expecting for the remainder of this year when it comes to commodity costs as well as foreign exchange. All of this having to do tangentially with tariffs. Explain what you guys are announcing today.
Yeah, I think first, just to provide a bit of context, Phil, when you look at the second quarter results, very, very solid results in the face of a more difficult macro environment. I mean, $3.2 billion of profit and 8.7% margins are solid. With that said, as we moved through the second quarter, there were a couple of dynamics that impacted our results, both in the second quarter and obviously our guidance going forward. That is continuing escalation in commodity prices driven by a number of market forces, as well as perhaps specific to General Motors, significant devaluation of currencies in South America, primarily Brazil and Argentina, which is driven by some obviously political uncertainty there. And as we look at the year, we felt it was appropriate to reduce our guidance. Net, when you look at these, the unmitigated risk associated with it, we put it in the range of about $1 billion. For the year, and obviously we'll continue to work to optimize around that, but that's the market reality that we're dealing with right now from a macro standpoint.
Chuck, let's talk about the market reality when it comes to tariffs. You source about 90% of your steel and aluminum in the U.S., so while you are not directly impacted by tariffs, the steel and the aluminum tariffs, that impacts the entire global market, which ultimately drives prices up, correct?
Well, what I would say, and I'd go back to my earlier comment, we have seen an escalation of commodity prices across the spectrum of commodities, including steel and aluminum, that has been driven by market forces. And there are a number of market forces at play. So I would just say, we're addressing that challenge. That challenge is greater than what we expected when we entered the year, and we'll work to mitigate as much of that as we can.
Melissa, go ahead.
Melissa Lee, back in studio. I'm just trying to understand how much of that guidance cut was due to increased commodity costs. So it's as much as 60 cents lower from the high point of your prior guidance. How much of that was because of increased costs? And I'm asking this because I'm just thinking, if the president said, this trade war is over, the tariffs are gone, how much can we expect guidance to come up because of that?
Yeah. I'm not going to attribute the commodity price increases to tariffs or a removal of tariffs or any other announcements. I would say that of the $1 billion headwind that we have, that we've identified for the year, roughly half of it is related to currency, and that's primarily in South America, and roughly half of it is related to commodities. And it's not just steel and aluminum; it's oil-based commodities, it's resins, it's fuel. When you think about our logistics costs. And again, market forces are driving this. It's driving it, in a much more of a magnitude than we expected when we started the year, and that's what's fundamentally driving our change in our outlook for the year.
Chuck, I'm curious from your perspective, what kind of an impact have you noticed? And I know there's not a lot of vehicles coming in from China. The Buick Envision is most notable, but what are you doing in terms of, as a corporation, with regard to those vehicles? Have you announced how you're going to adjust pricing here in the United States because of the tariffs that have been put in place?
Look, if you start overall from an overall trade dynamic, at this point in time, there are a number of moving pieces, a lot of uncertainty, a lot of volatility in that, and we continue to engage at the appropriate levels with the government across a wide spectrum of potential implications. We've done nothing specific to the Envision relative to pricing or plans for the rest of this year, and I wouldn't anticipate that in the short term. We continue again to monitor and evaluate the situation. As you can imagine, this is a pretty complex set of dynamics when you think about the global footprint, the global supply footprint, and how ultimately this will all come together. So we continue to monitor, evaluate, and engage appropriately.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.